day, all. Ira Epstein of Linn Associates with your agriculture update for a pretty wild day in agriculture on this Tuesday. And we're now at the 12th of March, 2019, and we're about 3:35 p.m. Central Standard Time. Wheat exploded. Now, we were due for a pop at some point. Whether it's going to have any follow-through, that's going to be the big question. There's plenty of world wheat. The market had come down dramatically, but is this the beginning of something more? It carried the beans with it, and it carried corn to a certain degree with it. So can't get away from that. You know, the whole day's been full of talking about airplanes, as you can imagine, and Brexit. And in Brexit, Miss May lost another very important vote today. We might be saying goodbye to her the way that it looks like her support is fading. In looking at the weekly area chart of closes, you can see how beans have come down, and they've gotten a bounce. They're up for the week 1 penny. So you can't say it's more than a little bitty bounce. And bias is turned down because the market's under the 18-week average of closes. When you take a look at this, you had an outside day up today, which means, and by the way, it's called a key reversal as well. Why the key reversal? Because it's the lowest low of a break and you had an outside day up. That is how traders look at it. Take out today's low in the next 2 trading sessions, and this will be no more than a bounce, and the market could, with some vigor possibly, try to go down to some lower level. Could this be a near-term trading bottom? You got to look at it both ways. Well, until it's taken out, it certainly could. You don't have a pattern that I can make sense out of in the terms of a straight downtrend. That ended when you got down here, went back up there, and while you've come down, you're back up into that low area one more time. When you take a look at what's happened with moving averages, they're bearish. You had a bearish crossover, which is when the 18-day average gets under the 100. It happened right here, which was Friday, and the market has done its job in making new lows, and today you're getting a reversal. It's also Tuesday, and so often we get in the marketplace Tuesday reversals. You'll hear it over and over if you're a technician. The question is, does it have any leg to it? On the rally, I'd look for pretty sizable resistance at the 912 to 916 area. Certainly if the market had good news out of China, that could prompt something. But the way that Mr. Lighthizer was speaking today in front of the Senate committee, it didn't sound like that's in the immediate future. I certainly, from what I'm hearing, am still not seeing anything for a March 27th possibility of a Mar-a-Lago meeting. Getting over and back over the lower Bollinger Band, I expected it, and you should. Why? If you take a look, you were under the market day 1, day 2. On this day, the market had finished just over the lower band, so we had 2 days in a row under it on a stretched out position, and you're back over that band today. Only 5% of the time do you stay under the band, but this is also called riding the lower band. The word riding comes in that you're every day hitting that band. We'll see if that happens again tomorrow. In the soybean, in terms of momentum, you did no damage to the bear market. You have here now 2 days in a row where the market has got readings under 20. The day before the readings were under 20, but not the day before. Tomorrow's a key day. Get a break in soybeans tomorrow, and you probably convert from being oversold to embedding, which often leads to a challenge for lower prices. In the meal market, you're just plain oversold. The market had hit the lower Bollinger Band now 3 days in a row. Today it's back over it, but it's not even a day where I'd say a powerhouse day to the upside. Resistance still looks to me formidable at 307, but the 307.70 area, but because you're oversold, I'm not convinced that the pros will step in an aggressive way. The market that could rally more than the others in terms of looking better on the chart is the soy oil. It probably has a lot to do with the crush spread, but right now this market looks like a candidate to at least challenge the 100-day average, the 18-day average of closes because you lost the embedded reading. Do you notice that you've got a 20 reading in there on the close? This was both numbers under 20, both under 20, both under 20. When you lose that reading, often price and the 18-day average make a run at each other. It's not an awful lot from here. It's all of 13 points, but I wouldn't be surprised to see it hit. In the corn market, key reversal, outside day. Again, at the lower Bollinger Band. If we take away today's action, you can see how this market was fighting at the lower Bollinger Band here, 3 days in a row. Today's the 4th. You got down to it, reversal day. You'd have to take out today's low to reinstate some real bearishness in the market because you had the outside day up. And if you take a look at what's going on with the readings on the embedded, both numbers under 20, both were under 20, not under 20 the day before. If you get a down day tomorrow in beans and corn, they're both probably going to embed. In the wheat market, the battlegrounds, you lost the embedded reading right on the close by a half a point. Now, a half a point means that, and because it closed near the high of the day, you're probably going to lose that reading, stay with it lost overnight. And the question is, does it slip back at all or not? This is going to be an important day. And the question is, do you get over this number of 464.25? Let's assume you do. And let's assume the market wants to rally. I'm still going to stick my neck out and say 468 could offer some serious resistance. But the fact that you lost the embedded reading, the only time you can get it back is the next day. And if you do, it's a trap for the bulls on this day. But it's also a sign that internally the bear trend has weakened. In the sugar market, you still have the pattern of lower highs, lower lows with an embedded reading. Until the red line gets over 20, this market still continues to look to me on the bear side. In the coffee market, remember what we were talking yesterday, this market just hasn't had any rally capability at all. It has trouble just getting to the 18-day average and holding it, and it is oversold. So I do think some pros were taking money off the table at the lower Bollinger Band today, because each time we've hit that band, we seem to either go sideways right after it or get a little rally. Now, the cocoa market's full of divergence. You've got bias down because you're under the 18-day average. Yet with today's action, you've got a pattern of higher lows and higher highs. So bias down, swing line up, momentum is trying to turn up, which I think could put in play, if you get that rally, anywhere between the 2250 to 2270 level. You'd need to close over both those numbers to say, cocoa looks like it could have made a bottom. The jury's out as far as I'm concerned. In the cotton market, there's a bullish bias at this time of the year to it, and the market's acting better. The last rally high was 74.90. It squeaked and got through that. It stopped against the upper Bollinger Band, as you'd expect. One of the things I teach, and because I teach it doesn't mean it has to happen, but one of the things I teach is the first time you hit a Bollinger Band is where I think, from everything I've learned in 5 decades of this, it's where traders often take some money off the table because you're not certain if it'll follow through. You're never certain, but the fact is you get to these points, and if you go back on your chart enough time, the idea there is, okay, if you got X amount of contracts, you should get something off the table against them and move your stops or protect yourself mentally, whatever you do. In the cattle market, you've gone again from the upper Bollinger Band to the lower. I don't know how to trade markets like that. You're making higher highs, lower lows. It's just whipping back and forth. Very, very deadly in it. The same's happening in the feeder cattle. You got the lower low. You went to the upper Bollinger Band within 2 sessions after that and right back to the lower Bollinger Band. The hog market's in a resistance zone, but it's getting help. And the help it's getting is not off the chart. The help it's getting is that today China announced that they will not be taking in pork from Vietnam because Vietnam is now getting the swine fever. And as the hogs get the swine fever there, well, they're contaminated. So now their public doesn't want it. So that puts America back in play. And I say that while traders are thinking it because we heard today that crude oil shipments will make it to China by May from the U.S. So very quietly, there's things behind the scenes going on. A lot of traders have thought pork would be a play, and they're getting that right now. You know, one of the things that you have to learn to do is keep up with technical indicators if you watch my videos. You're watching them because you're a market technician. And we've put together two, with the help of our friends from Futures Magazine, and they're no longer in business. I hate to say that because I love the people there, love the magazine, but times change and magazines have a hard time in business. And as you can see with them, they put together all these different ideas, and we've got these indicators. We've got volumes 1 and 2, how you work with it, Folks, in reading them, I think they're as good as they get. So if you'd like to get them, it's really simple. Go to our website. You can just click on there and you'll see our carousel of free offers. Best yet, call our staff, or you can click right up here and it'll take you right to that area. Sign up for what you need. I'm Ira Epstein. Have a great